Let me give you a number, $10 million. That's the sale price of your business, and your basis, what you originally put in, was $1 million. So the day you sell, there's a $9 million capital gain sitting on the table. You don't walk away with $10 million though. You have a federal tax bill around $2.1 million. $2.1 million gone off the top. Plus, depending on where you live, your state might want their cut too. Now here's what most owners do. They call their CPA the week the letter of intent comes in. The CPA says, yeah, you're going to owe a lot of money. And everybody just kind of accepts it. They treat that $2.5 million number like weather. Like it's just what happens. It's not just what happens though. It's what happens if you do no planning. Today I'm going to walk you through the entire arc. The moves you make before the sale to shrink that $9 million gain, some of which can wipe out millions in tax legally if you start early enough. And the moves you make after the sale, when most of your wealth is sitting in a taxable brokerage account, to build a retirement where you're realizing gains year after year and paying the IRS close to nothing. This is the big one. $10 million exit, $9 million in gains. Let's build the plan. This is episode 4 of the bracket. I want to frame the whole episode with one idea, because if you take nothing else, take this. The tax on a business sale is not determined by the sale. It's determined by the structure of the sale and the planning done around it. The same business with the same buyer and the same $10 million price and 2 different owners can walk away with tax bills that differ by millions of dollars, purely based on what they did in the years and months beforehand. And here's the cruel part. Almost every powerful lever has a time fuse on it. The single most valuable strategies require that you act years before the closing. By the time the buyer's at the table with a signed letter of intent, half your options are already dead. There's an old line in this work. The best results come from restructuring before the buyer shows up. Once the deal is in motion, you're playing defense. So I'm going to split this into 2 halves. First, the pre-sale playbook, how you attack that $9 million gain before it's locked in. Then the post-sale playbook, how you manage what's left over a full retirement. And I want to be honest with you up front. The pre-sale moves are where the millions of dollars are made. The post-sale harvesting is where the steady, year after year tax-free income is. You want both though. But if you're early, if a sale is 3 or 5 years out, the pre-sale half of this episode is worth more than anything else you'll hear this year. Let's start there. The first thing I ask any owner who might sell, is there any chance your company qualifies for qualified small business stock under Section 1202 of the tax code? Because if it does, this is the single most powerful tax break in America, full stop. Here's the deal. If your business is a domestic C corporation and the stock was originally issued to you and the company's gross assets were under a threshold when the stock was issued, and you've held it long enough, you can exclude a massive chunk of your gain from federal tax entirely. Not defer, exclude, which means you make it disappear. Now the rules got better in 2025. The One Big Beautiful Bill Act, signed on July 4th of 2025, overhauled Section 1202 for stock issued after that date. There's 3 big changes. The first is the old rigid 5-year holding period got replaced with a tiered schedule. If you hold for 3 years, you can exclude 50% of the gain. 4 years and at 75%, 5 years or more, and that's when you can exclude 100% of the gain. 2, the lifetime exclusion cap for a company jumped from $10 million to $15 million, or 10 times your basis, whichever is greater. And then 3, the company's size ceiling rose from $50 million in gross assets to $75 million, so bigger companies can now qualify. Let me put that against our example. $9 million in gains. If that stock is qualified small business stock held 5+ years, you could exclude up to $15 million of gain, which means the entire $9 million could be federally tax-free. And your $2.1 million tax bill goes to roughly 0 at the federal level. Now the catches, and they're real. First, and this is enormous for listeners at the state level, qualified small business stock is a federal exclusion, and not all states conform. So even if you wipe out the federal tax, some states will still want their own flat rate cut on the gain. So know your state because it'll change your math. Second, the partial exclusions at 3 and 4 years have a nasty detail. The portion you don't exclude gets taxed at 28%, not the usual 15 or 20. So the math often says if you can possibly hold the 5-year mark for the full 100%, do it. The jump from 75% to 100% on a $9 million gain is worth millions of dollars. Third, most operating businesses people sell are not C Corps and may be in excluded fields such as health, law, financial services, consulting, and hospitality. All of those get shut out. So this won't apply to everybody. But here's why I lead with it. If a sale is several years away and you have any flexibility on entity structure, the conversation about whether to convert to a C Corp and start the qualified small business stock clock is potentially a 7-figure conversation, and almost nobody has it early enough. Founders learn about QSBS weeks before a sale, when every planning window has already been slammed shut. And there's an advanced move on top, stacking. Because the cap is per taxpayer per company, you can shift shares into separate non-grantor trusts for your kids and other beneficiaries, each of which gets its own $15 million exclusion. A founder with a gain well above the cap can multiply the exclusion across multiple trusts. That's sophisticated, it needs real legal work, and it has to be done well before the sale. But on a big exit, it can be the difference between excluding $15 million and excluding $50 million. Okay, so say the QSBS is off the table for you. Whether you're the wrong entity, wrong industry, or you didn't hold long enough, you're not out of moves. There's another lever you could pull, and one we use often. That's the charitable remainder trust, the CRT. Here's the mechanic, and it's elegant. Before the sale closes, this timing is everything. You contribute a chunk of your business stock into an irrevocable trust. The trust sells the stock to the buyer. Because the trust is a tax-exempt entity, because it's a charitable remainder trust, when it sells, it pays no capital gains tax on that sale. The full, undiminished proceeds get reinvested inside the trust and grow. You as the income beneficiary then receive payments from the trust, which is typically a set percentage of its value every year for your life or for a set number of years. You pay tax on those payments as you receive them, spread out over decades instead of all at once. And whatever's left at the end goes to the charity or charities that you choose. As a bonus, you get a partial charitable deduction up front the year you fund it. So what does a charitable remainder trust actually buy you? 3 things. The first one, you convert a giant, single-year taxable event into a smooth stream of income taxed gradually over your lifetime, which could keep you in lower brackets year after year. Second, the assets grow tax deferred inside the trust. So you got the full pre-tax amount compounding instead of the after-tax amount. On a $9 million gain, having the whole thing working for you instead of $6.5 million after taxes is a massive head start. 3, the assets are out of your taxable estate, which matters for estate planning. There are trade-offs though. The CRT is irrevocable. Once the stock goes in, you can't get it back. It's a one-way street. The remainder generally goes to charity, so if this fits the owners who have actual charitable intent, that's not just tax allergy. And the payout has rules. There's a minimum annual payout percentage set by the IRS, and the charity has to be projected to receive a real remainder. This is a structure for someone who wants lifetime income, has philanthropic goals, and wants to defer and smooth a big gain, not someone who wants to clutch every dollar. The way I see this used most often, a partial amount is donated to the CRT, and the rest is sold directly to the buyer. The CRT is funded enough to maximize charitable intent and to offset a large chunk of taxes generated on the portion the business owner still holds personally. This is the best of both worlds approach. So for the right owner, you take a sale that would have cost $2.5 million up front, and instead you got a portion that provided an upfront tax benefit paying you income the rest of your life. What remains when you pass goes to the charities you designate, and you have flexibility with the remaining money that was never put into the trust in the first place. Now there are a few more pre-sale tools, and I'm going to go through these faster because each fits a specific owner. First is installment sales. Instead of taking all $10 million at closing, you structure the deal so the buyer pays you over several years. You only recognize the gain as you receive each payment. So you spread the $9 million gain across, say, 5 or 8 tax years instead of cramming it into one. So why does this help? Because it spreads you over all the tax brackets over multiple years, and it can keep your income under the net investment income tax threshold in some years. The risk is real, and you have to name it. You're now the bank. If the buyer's business craters, your remaining payments are at risk. You're trading tax efficiency for credit risk on the buyer. You also might recognize interest, which is ordinary income, on the interest rate you charge the borrower for not paying you up front. That also fills up your tax brackets and is something to plan around. Then there are ESOPs. If you've got a C Corp and you're charitably minded toward your employees rather than a charity, selling at least 30% of the company to employee stock ownership plan can let you roll the proceeds into other U.S. securities and defer capital gains tax under Section 1042. It's niche, but for the right owner who wants the business to stay with the team, it's powerful. The theme across both these strategies is you're either spreading the gain over time or deferring it into another vehicle or transferring it to a tax-advantaged buyer. None of these make the tax vanish the way QSBS can, but they all convert a brutal one-year hit into something far more manageable. And every one of them has to be set up before the deal closes. Once you've signed and the cash hits your account, these doors are shut. Now the one nobody talks about, and it bridges us into the post-sale half as well, is you want to start your loss harvesting engine years before you sell. And here's the idea. If you know a liquidity event is coming 3 years out, 5 years out, you want a direct indexing portfolio already running and banking capital losses in the background. I'll explain direct indexing fully in a minute, but the headline is this. It's a strategy that throws off harvestable capital losses every single year, even when the market's up and even when your investments are up. Why does that matter for the sale? Because capital losses offset capital gains dollar for dollar with no limit. So if you spent 3 or 4 years before your exit stockpiling harvested losses in a direct indexed account, you walk into the sale year with a war chest of losses sitting on your tax return, carry forward, ready to deploy against the gain from the business. And let me make it concrete. Say over 4 years of direct indexing sleeve banks $1 million of net carried forward losses. The year you sell, that $1 million in losses goes straight against your $9 million gain, knocking it down to $8 million. That could be $200,000 plus of taxes saved just from having the machine running in advance. And critically, loss harvesting is front loaded. A portfolio harvests the most losses in its early years when positions are freshest and most likely to dip below. So the time to fund it is early and large, before everything appreciates and the losses get harder to find. You cannot build that war chest overnight. The owner who sets this up the year before the sale gets a little. The owner who sets it up 4 years out, 5 years out, a decade out gets a fortune. It's the same strategy. The only variable is when you start it. And of all the strategies we mentioned so far, this is the easiest one to set up. It's as simple as setting up a brokerage account, buying a direct indexing strategy, and collecting losses on the positions that are down. And the idea, since you are following an index like the S&P 500 or the Russell 2000, is you are getting close to market-like performance with some tax advantages. There's no changes to your corporate structure, no rules on small business stock, no charitable events to manage. Just your hard-earned dollars invested to make your liquidity event less of a tax burden. The way I typically set this up for clients depends on their liquidity and their potential gains. What I've found with many business owners who spent years building a business is liquidity often becomes much more meaningful in the decade before the sale, which makes sense because they spent years plowing thousands, even millions of dollars into their business and reap the rewards of that near the end and then eventually through the sale. So we fund the account over 5 to 10 years before the sale. What we find is that first-year losses collected typically range from 7 to 15% of the account value, depending on what strategy we follow and potentially using leverage to amplify those losses. They also achieve close to market-like returns and have a tracking error of plus or minus 2%, which means that if the index is up 10%, we expect the portfolio to be up 8 to 12%. The math works the same in the other direction as well. Losses tend to get smaller over time on your contributions though, generally decreasing by 50% each year and being completely used up around year 5. This is why we contribute to the account annually instead of just one lump sum. So tying this to our $10 million sale example, let's say the business owner can reasonably put in $500,000 a year for the 5 years leading up to the sale. Losses would range from $300,000 to $600,000 in the median scenario over 5 years. That implies tax savings around $71,000 to $142,000 when the business is sold. And those are only tax savings at the federal level. That's not a huge amount of money in the context of the sale, but it's something they no longer have to send Uncle Sam, and a strategy that can be used in conjunction with some of the previous ones mentioned. All right, so now the deal's closed. You use what pre-sale leverage you could. Now you've got, let's say, $6, $7, $8 million sitting in a taxable brokerage account. Non-qualified money, not in an IRA, not in a 401k, just a big taxable pile. Most advisors look at that and see a problem. You'll owe capital gains every time you sell something. I look at it and see the single best raw material for a tax-free retirement that exists, and here's why. You now control your income. That's the magic ingredient, and almost nobody has it. A retiree on a fixed pension has their tax bracket filled for them involuntarily, but you, sitting on a pile of taxable assets and cash, no wages, years before Social Security, and before required minimum distributions, you can choose your taxable income each year. And that control is what unlocks the 0% capital gains bracket and opens the door for what I like to call the pseudo Roth. Here's the bracket. In 2026, married filing jointly, the long-term capital gains rate is 0% as long as your taxable income stays below $98,900. And because that's taxable income after deductions, you stack the standard deduction on top. That's $32,200 for a married couple. And then you've got a real stealing of about $131,000 of gross income before a single dollar of gain spills into the 15% bracket. So picture it, you're 62, you just sold, living off cash and the return of your own principal, which isn't taxable income. It's just getting the money back that you put in. In that low-income environment, you deliberately sell appreciated positions to realize long-term gains right up to the $98,900 line. You pay zero federal tax on those gains, then you immediately buy the position right back. And why do you buy it back? Because there's no wash sale rule on gains. The wash sale rule only blocks you from claiming on a loss. On a security, you rebuy within 30 days. On a gain, you can sell and rebuy the same thing the same minute. And when you do, you've reset your cost basis upward to today's prices, tax-free. You own the identical investment, the same dollar amount, but now the IRS thinks you paid more for it, which means all the future appreciation you just locked in will never be taxed again. You've walked your basis up to the zero bracket in broad daylight completely legally. Now let's bring the loss machine back in, because post-sale it does double duty. Direct indexing now fully explained. Instead of buying one S&P 500 index fund, you own the actual underlying stocks, hundreds of individual companies directly weighted to track the index. Same market return, but now you hold 3, 4, 500 separate positions instead of one blended ticker symbol. Why does that matter? Because in any given year, even when the index is up, some of the stocks inside it are down. In a regular fund, that's invisible. It's all one position. But when you own the names directly, your manager sells the losers to harvest the losses, buys something similar to keep your market exposure intact, and banks the loss. Up market, and you're still generating losses. That's the whole magic of direct indexing. Post-sale, those harvested losses do two huge jobs. Job one is they extend your tax-free harvest beyond the bracket ceiling. Remember the 0% harvest caps out at around $130,000 of gross income. But your direct index losses can offset gains above that line, dollar for dollar. So you harvest gains up to the zero line for free, and then use the harvested losses to neutralize additional gains you take above it. The two strategies interlock to push your tax-free capacity well past the bracket alone. The second job, and this is the big one for our seller, is unwinding concentration. A lot of owners don't get all cash. They take some stock in the buyer, or they've got a giant low basis position they need to diversify out of. The concentration is a risk and a tax bomb. The direct indexing sleeve running alongside it generates a steady stream of losses specifically engineered to offset the gains as you sell down the concentrated position over several years. You de-risk out of the single stock, and the harvested losses absorb the tax hit. On a multi-million-dollar concentrated position, that's one of the highest valued things a planner does. So the post-sale picture is a 2-cylinder engine, the 0% gain harvest walking your basis up tax-free, and the direct indexing lost harvest mopping up everything that doesn't fit under the line. Run both every year in the low-income window before Social Security and RMDs arrive. And the beautiful thing is this is likely not a new strategy to you. You used it pre-sale as well to save money on the initial tax when you sold. But also let me be the guy who tells you where the bodies are buried, because every one of these has bitten somebody. The gain stacks on itself. The gain you harvest counts towards the income that sets your bracket. Harvest too much and the excess shoves part of your gain over the line into the 15% zone. This is the scalpel. You harvest up to the line, modeled to the dollar, and not past it. Next is net investment income tax. The 3.8% surtax kicks in at $250,000 of modified adjusted gross income for a couple, and it's not indexed for inflation. So in a big year, say you harvest aggressively and take an installment payment and convert an IRA, you can without noticing. Third is state tax. Everything I said about the 0% harvest is federal. Different states tax gains at different rates, some not at all. Your tax-free harvest isn't fully tax-free at the state level. Same warning with qualified small business stocks. Make sure you know your state rules. And then for those of you with ACA subsidies, retiring before 65 and buying health insurance on the exchange, your harvested gains count as income for subsidy purposes. You can save 15% in capital gains tax and lose more than that in health insurance subsidies. Coordinate the harvest with the healthcare plan. And then there's also Roth conversions which compete with your harvest. A lot of you should also be doing Roth conversions in these gap years, but conversions are ordinary income. They fill the bracket from the bottom and eat your harvest room. You can't max both in the same year. Each year you decide deliberately, is this a harvest year or a conversion year or a measured blend? That annual decision is exactly where real planning earns its fee. And don't forget about dividends and interest. Let's be real, if you sell a business for $10 million and book a $9 million gain, even after you pay taxes, you're likely left with around $8 million to invest. That money will kick off dividends from your stock positions and interest from bonds and cash. It's extremely important to monitor how much income your portfolio kicks off. If it kicks off too much, it uses your space before you can harvest anything. If it kicks off the wrong kind of income, mainly interest and non-qualified dividends, it flows to your ordinary income, which gets taxed as soon as you exceed your standard or itemized deduction. It is important to set a portfolio to do a few things. Control for dividends and interest, but also look at some alternative investments and gifting strategies. The less forced income you have, the greater your chances of operating within the 0% bracket. And finally, don't maximize this and forget about your estate. There's a good chance that if you're selling a business for $10 million in your 50s or 60s, you might be trending toward a taxable estate. Factor in the price of your house, any other savings you have, some old retirement accounts from employers before you started your business, and a potential inheritance you yourself might get. And as that grows, you might start trending towards a taxable estate. Currently, the estate tax exemption is $15 million per person, and that is indexed for inflation every year. Selling a business for $10 million and growing the proceeds at market-like returns for a decade or two could have you exceed that exemption threshold. The result is approximately $40,000 in tax on the difference above the exemption amount. So let me give you the whole thing in one breath, the way I'd map it out for a client with a $10 million exit coming. Years before the sale, check your qualified small business stock eligibility. If there's any path to qualifying C Corp stock held for 5 years, that one conversation can be worth millions of dollars. Stand up a direct indexing portfolio and let a bank carry forward losses while they're most plentiful. Plan asset location so that after the sale, you've deliberately got a healthy pile of taxable money, because that's the engine, not the bug. And then as you're approaching the sale, decide on structure. Does a charitable remainder trust fit your charitable goals and need for lifetime income? Does an installment sale fit your risk tolerance? Deploy your stockpiled losses against the sale year gain. Every one of these is set before the wire hits. Then there's the gap years. So sale until Social Security or your required distributions start. This is harvest season. Live partly off cash and basis to keep reported income low. Each year, harvest long-term gains up to the 0% ceiling, about $130,000 for a couple in 2026. Sell and rebuy to step up your basis tax-free. Run direct indexing alongside to throw off losses and extend your tax-free capacity and unwind any concentration. And each year, choose harvest, convert, or blend while watching your net investment income tax, ACA subsidy thresholds, and your state taxes. Do all of that, and you walk into your 70s with a stepped-up basis across the portfolio, a chunk of your IRA already converted to Roth, the sale year gains shrunk by years of pre-planning, and a decade of gains realized at the federal rate of 0. The IRS, who you assumed would be your single largest expense, becomes an afterthought. $9 million of gain does not mean $2.5 million of tax. But the difference between those two outcomes isn't luck and it isn't a loophole. It's planning that starts early. The owner who calls after the letter of intent gets a haircut. The owner who calls 3 years out builds a tax-free retirement. If you're anywhere near a sale, the clock is the most valuable thing you own. That's the episode. Don't forget to subscribe to the podcast for weekly updates just like this. The rest of the bracket math lives right here. This is the bracket. That's it for this episode of The Bracket. If something here made you rethink a decision you were about to make, that's the whole point. Go deeper before you act. And if you want help applying any of this to your own situation, the team at Nav Wealth Partners does exactly this work. Tax strategy for the distribution years, for households like the one this show is built for. There's a link in the show notes to schedule a conversation with one of our advisors. Click to see if you're a fit. And if this episode was useful, do me one favor. Follow the show and leave a rating wherever you're listening. It's the single biggest thing that helps another retiree with the same questions actually find us. Quick but important note. Everything on this show is educational and for general information only. It is not personalized investment, tax, or legal advice, and listening does not create an advisory relationship with Nav Wealth Partners. Nav is a registered investment advisor. Your situation is your own. Please consult a qualified professional before acting on anything you heard here. I'm Ryan Knoll. Thanks for listening to The Bracket.